about 9fin. My name is Max Frumes, the global head of LevFin and Distressed for 9fin. I'm here joined today by Alec Keblish, senior credit analyst here in the U.S. with 9fin. And today we're going to talk about, among other things, the Strait of Hormuz. And I just want to point out and give a lot of credit to Alec here. February 25th. He put out a story for 9fin called "What Would U.S. Strikes on Iran Mean for High Yield?" And this was before there was really high odds on Kalshi and Polymarket, right? So, Alec, welcome. And could you walk us through, right, what led to you putting out this very prescient piece on what would a potential war in Iran mean for the high yield and the leveraged loan market, and then some of the process by which you go about analyzing credit here for 9fin.
Thanks, Max. So I guess this all kind of started back in September, actually. I put out a piece, ironically, looking at the impact of low oil prices on upstream E&Ps. And back then, prices were approaching the $60 a barrel threshold. And with some oversupply from OPEC, that was expected to go a little bit lower. And one of the things I flagged as being a potential black swan event was the closure of the Strait of Hormuz. That was really the only major potential supply shock that could reverse this trend meaningfully enough to spike oil prices again. And back in February, right after the State of the Union address, the U.S. stationed troops in the Middle East with no clearly defined end state. And so at that point, the risk of strikes on Iran kind of came into being. And at that point, I decided to dig back into it.
Could you, describe the Strait of Hormuz for me? Right, I gotta admit, maybe a little ignorant, but I never really crossed my mind how important it was for the global economy. And just describe it a little bit, and it's the reason that all analysts should be familiar with its importance.
Yeah, so the Strait of Hormuz is a waterway in the Gulf off the coast of Iran that is the narrowest stretch of water in that Gulf. I believe it's something like 3 kilometers across. And through it flows roughly 20% of the world's oil supply, mostly going to Asia, a very small portion going to Western countries. But 20% of the world's oil supply is a massive number. And that's why it's been such a hotly contested area. And among that, not just crude oil, but there's a lot of LNG coming from countries like Qatar, which is one of the 3 largest producers, along with the US and Australia. And we're going to get into that a little bit later. But a huge amount of global marine shipping flows through this strait.
So when the prospect of war with Iran came up, now it's time to start thinking about, as a credit analyst, which credits are going to be impacted. All right. So can you break down some of the categories of the credits that are going to be impacted and what the guesses were and then what the reality was?
Yeah. So the clearest one is, energy producers. Crude oil prices are extremely sensitive to any geopolitical shifts. And this is one of the clearest catalysts we've seen in a while. So that's mostly upstream producers because their revenue profile is directly tied to the cost of oil. The further downstream you get, the less directly that is impacted. And it's more of a supply and demand dynamics, as you get to the midstream and downstream producers. Further downstream, you have the users of oil. So there are a lot of companies that fall into this bucket. This is something like chemicals or transportation companies or manufacturing and even insurance. A lot of the biggest high yield issuers in the insurance space offer insurance to marine transportation providers. And when there's a threat of war like this, insurance premiums go up, and depending on the outcome of that war, the insurance companies win or they lose. In this case, there haven't been too many significant strikes on the water, but there have been a few, and we haven't seen that flow through to these companies yet, but it'll be interesting to see when they report earnings if any of those premiums have been paid out. So when we put this piece together, we pulled together some research from a bunch of firms in the space. So Goldman, Rystad Energy, ING, basically flagging some of their research in the past that looked into what would happen to oil prices in case of a closure of the Strait. And what we found was estimates were between $5 to $10 a barrel of increase to crude prices for every million barrels a day that were disrupted. So again, 21 million barrels a day flow through the Strait. And what we saw was, of the 90 ships per day, roughly since the start of the year that have been going through the Strait, that fell to 10 per day after the start of the war. So implicitly assuming 18 to 19 million barrels a day of disruption.
So that would have been, what, $90?
Yeah.
Yeah. Okay.
And so, just for some context on oil prices, they started the year at 60. When we put this piece together, they were a little above 70, which was the first time they'd been at that level since July. At the peak, they were somewhere between 115 and 120. So if we're assuming that 18 to 19 million barrels a day figure is correct, and if you asked analyst number 3 at Citrini, he might say that's a little bit lower. We would assume that, it would be somewhere in that 150 range. But with prices between 115 and 120, that's roughly $3 per barrel per day of price sensitivity as a direct result of the war. So the likely explanation for this isn't that Goldman, Rystad, and ING were wrong in their estimates, but that the market was effectively pricing in the taco trade. Trump always chickens out. And I think nobody on either side really wanted this war. And for that reason, nobody expected it to continue and develop into something long lasting. I think to everybody's estimates from before this whole thing happened, it's gone on a lot longer than people expected. I don't think anybody expected Iran to be able to hold on as long as they have. And we're, at the point of a potential peace negotiation, but the U.S. has still maintained blockades on Iranian ports. And so it's kind of anyone's guess where we go from here. But when you have a president who is threatening to wipe out an entire civilization and then agrees to a ceasefire on the same day, it's really hard to price any of this in.
Yeah, as we do have to deal with some macro global uncertainty here. And what we try to do here at 9fin is, capture all the chaos, make it so that our clients can follow along with these minute, quick changes to all these very, very important themes. And so once the first missile started firing on the initial, U.S.-Israeli assault, I followed up with your piece on, let's take a look at all the unhedged companies that are out there. And that we published a list of companies that had mentioned that they had taken off their hedges or had very few or no hedges on the price of oil, including a number of prominent airlines, American Airlines, and then most topically JetBlue. We put out a piece on JetBlue on what its liability management exercise options were given the close read of its credit documents. And then there's these building, housing products companies, most specifically like Geldwin, that were already a little stressed before this event has increased the price of them doing business. And now we have creditor groups that are forming there, and people looking at their options to deal with their debt stack because the cost of doing business has substantially increased. And we're following all these things. And it keeps going back and forth. For you, what I guess we could focus in on JetBlue, right? How do we take the current uncertainty, the actual fact of the price of oil, and I guess what people are trying to price in and produce meaningful work here?
Well, I think stepping aside from JetBlue for a second, I think it's worth recognizing the fact that the S&P closed over 7,000 for the first time ever yesterday.
Exactly.
reversing all of the gains from the Iran war. High
the
yield
losses,
spreads, correct. High yield spreads started the year around 280, 290 basis points, jumped up to 350 at the end of the March, and they've reversed as well. They've tightened back to kind of where they started the year. So what we're seeing is an incredibly resilient market backdrop that seems to be at face value pricing in the fact that this is not going to be a sustained shock. Obviously, for a company like JetBlue, you have, tall capital structure with upcoming maturities. You are relatively poorly positioned in an industry that already has razor thin margins, and oil prices are a significant input. So I think those three things together, any company in that position is likely to have some headwinds as a result of this. Qatar's LNG facilities were struck, and that impacts 17%, I think, was the estimate of their production capacity, and that's going to be an overhang for a couple of years. So if you're a company like Venture Global or Cheniere Energy Partners that does LNG in the US, that's a good thing for you. But it's going to sustain higher prices in the long term. So anybody who's using, oil derivatives is going to face some of that pressure. And when we're already in an economy where growth is slowing, higher oil prices are not something that's going to help that. So I think the perspective is that a lot of these companies are going to face some continued headwinds, companies like JetBlue being one of them. But it's really anybody's guess on how long that's sustained. And I think, the current situation in Iran is very telling. Once we come to a resolution, there's going to be a lot more clarity, but it seems like the market painting, in broad strokes is optimistic about the current situation.
Yeah. And just the current situation. How many tankers are going through the Strait on a daily basis at this point? It's like at one point it was like one, right? Almost none.
Yeah, it was almost zero. It's ticked up slightly. It's still, maybe a little bit above 10, I think, based on the UN's estimates I was looking at. But it's, effectively a complete shutdown. When I wrote the piece on February 25th, I mentioned that a complete shutdown of the Strait was highly unlikely. And even though that happens, things have generally remained resilient across all corners of the market. Oil had that spike to 115 or 120, but it's back down below 100 where it's been this whole week.
Who knows? Well, and like as far as production is concerned, U.S. is in some ways now has an opportunity to be an exporter of oil and is well positioned in spite of, I guess, the alienation of its own allies. How does the world work around the Strait of Hormuz now, assuming that it's going to be stop and go?
So I think the biggest shift from all of this is just the supply and demand dynamics that have kind of been taken for granted being shifted around. So obviously Gulf oil has been a massive supplier to Europe and the East for years. And in the short term, it's likely that as those reserves start to deplete, the US takes over a lot of that export capacity. So obviously, if you're an upstream producer, opening or closing production is a very capitally intensive and time intensive project. And so it's not like all of these upstream producers are going to start opening these new wells tomorrow. It's a lot more complicated than that. And in the long term, there's going to have to be a lot of global partnership to figure out how to distribute oil effectively. But I think the clearest likelihood is that the US takes a lot of the share in the meantime, and the upstream producers, while prices remain high, which they should as supply remains low, they're going to have a good time.
And not to put you on the spot, let's status of Venezuela and where do they fit into this picture?
Yeah, so Venezuela is a tough situation. I mean, headlines, you look at the capture of Maduro and the US taking over Venezuelan oil supply. What's kind of missed in those headlines is that the Venezuelan oil, even though they have some of the biggest, if not the biggest reserves in the world, the infrastructure is old and the oil is really heavy. So even some of the oil majors aren't looking to, jump right into that market because they've been burned in the past. They would have to put in tens of billions of dollars to revive that infrastructure. And we in the US don't currently have the refining capacity for that weight of crude. So right now, there's not going to be a significant impact from Venezuela. I think long term, if that political situation starts to stabilize and the climate becomes more investable, then in 10 years, sure, Venezuela is going to be a
great.
massive,
10 years. That would be huge
anything can
support to
happen in 10 years.
the world's old support. It'll take quite some. So like a lot of these things are up in the air. You've pointed out the resilience of the the global markets, and also as far as just oil and gas companies and energy and production exploration companies, they went through a wave of bankruptcies. And so it's like they're used to these giant fluctuations, and there's not this so there's not as big of a disruption in that industry, even if things like prices drop significantly. So last question, in credits, where would you think is going to be the most near-term disruption, and places to follow and look for real volatility?
I think in terms of, if we're looking at tailwinds, I would say U.S. midstream natural gas, specifically because of the Qatari disruption. That was one of the things I flagged in the piece. And there's no Australian companies that have U.S. leverage finance exposure in that area, but that's another market that seems like it's going to do well. I would say if you look a little bit further downstream, airlines, if prices remain high, are going to face a bit of reckoning. Again, those are already businesses that have zero margins, and they don't have a lot of room to run. I think in all of this, one area that's also being overlooked, to your earlier point, is the building materials space. So since the start of the year, software, AI, the war in Iran, those have been kind of the key macro stories that people are following. But what I think people are missing is, again, higher oil prices when growth is slowing is likely to keep rates a little bit higher for a little bit longer, especially with all of this volatility. And that's going to have an impact on housing starts, which, all these building materials companies have cap structures that reflect the low rate, high activity of, 2020, 2021. And as those maturities start to come due, there's really no near-term catalyst for the residential housing market to have a meaningful return to volumes. I think people have been waiting for rates to come back for years now. I think since the start of 2024, people projected 4 rate cuts that year, maybe even 6. That didn't happen. Last year was slower than expected, and it's looking like rates are going to be flat this year. And if people can't get mortgages or can't afford mortgages, then they're not going to build houses. And if they're not building houses, building materials are going to be in lower demand at the same time when input prices are elevated. So I think that's one sector to really look out for, and that's going to be a bit of a slower burn. But over the next couple quarters, I think we're going to see some compression there. Obviously, the chemical space is another one that's already been going through a lot of distress. That's well documented. That's not really news, but I think a lot of the petroleum inputs there are another headwind to these companies. And so I don't think this is, assuming the war doesn't sustain, I don't think this is some major wave of distress that's coming, but I think there are pockets of the economy, especially the more exposure you have to oil and the more near-term maturities you have in your capital structure to begin with. So it'll be interesting to see what happens there. But I think right now, everybody's eyes are on a resolution in Iran, whenever and whatever that may be.
Indeed. And, we in distressed are never not busy. And there's a pent up amount of distressed debt, the highest amount, quantum of distressed debt since May of 2020. And a little bit of pause right now while people figure out where rates are going, where oil prices are going, and the like, and what disruption Claude will have on their business, or 9fin too. So Alec, is like great piece, always like great work. Like the credit team here is really top notch, using the best analysts, using the best technology is how 9fin does its job. And also you got your dog here, Ollie, who's knocking at the door wanting to talk to you. So I'll let you go.
All right. Thank you, Max. Great chatting.